We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tony Greer, trader and editor of the Morning Navigator. How are you today, Tony?
I'm great, Tom. Thanks for having me.
Great to have you back, and I'm looking forward to kind of diving into some of the ideas that you go through in your work quite a bit here. So you start to navigate trades for each quarter by setting out some broad dynamics of how you see some macro trends develop over that time period. So if you could, let's start with understanding how you saw the setup coming into this year, into this quarter, for the broad themes that you were expecting to play out.
Yeah, sure. I think a good way to approach that, Tom, is to look at it the way that I had been looking at it sort of pre-COVID, with the way the market was behaving and the way the market was behaving sort of into the COVID, even post-COVID, is that the Fed was inflating assets. And if you were long assets, you were going to be okay. Mm-hmm. Right. So that was like my main thesis that obviously had to morph when the Fed started raising rates and getting serious about inflation. So now it's kind of like we've got a counter force to the inflation that is sort of, I'm calling it sort of politically systemic type of inflation, right? If we're gonna go to carbon neutral at the speed of sound by 2030, there are certainly going to be a lot of inefficiencies and kinks along the way. And that are going to cause, I think, quite a bit of inflation if we're going to attack energy supply, alongside that transition. Mm-hmm. So with the idea that that is going to be, a consistent source of inflation coming from the political side, that the sort of central banks are stuck with fighting it as best they can, with their tools of raising rates and trying not to sort of collapse the stock market, which has been running on, excess liquidity for so long. So to go into that, that's kind of how the framework has changed for this quarter, for the first quarter playbook. And I'll be working on the second quarter playbook at the end of March in a couple of weeks. And the theme that keeps developing for me is that markets are totally chaotic right now. And I think a lot of it has to do with the yield curve being buried at, minus 75, 80 points. And I'm referring to 2s, 10s, just to pick the most basic one. Mm-hmm. The curve inversion, we're now, first of all, we're at a level where the curve is inverted steeper than we were before the dot-com bust and before the great financial crisis. The curve was inverted both of those times at, minus 30, 40 basis points. And here we are at minus 90 basis points, probably heavily involved in fifth generation warfare. And even for traders with 30 years of experience, I'm wondering which way to look when I wake up in the morning, quite honestly. Mm-hmm. So, I go back to that framework that the inflation that we're seeing is going to be, pretty consistent. They're going to have ways to fight against it, right? They sold the Biden administration sold a wad of the SPR that was tremendously effective in getting gas prices off of $5. And they made an announcement that they're going to sell some more. So there's an opposing factor, and like I said, the Fed's stuck in the middle. So we're going to figure out how the Fed handles this. What I care about the most to get to the point is what rates and what the dollar are doing. Mm-hmm. That kind of gives me the green light on how aggressively I can trade my commodity positions, if that's fair. All the commodities to me are kind of in a very similar layout where they're sort of, on the supply side, there's constraints on the supply side. Inventories are low. Demand seems reasonable, across the board for, most everything. And the price action sucks. Aside from even, recently things have backed off and kind of look pretty tame. And the Bloomberg Commodities Index is backed way off its highs. It's funny. I looked up the last time that we spoke was about a year ago, mm-hmm. and I was looking for the same thing where policy to cause a big commodity boom, and we got the commodity boom And then we are now literally a 180-degree turnaround and round trip to where we came from a year ago.
Mm-hmm.
So, that whole dynamic has been, partially caused by, the Fed fighting inflation with higher rates, the SPR being spilled out. We've had warmer than usual weather in the US, which has kept natural gas, literally just capped and falling for the most part. I think it may have turned around now, or at least it's trying to. But, that was an episode that we just lived through with natural gas going from 11 to 8 to 2 pretty quickly. So there are deflationary forces out there still, like there have always been. There's still commodity supply like there's always been. So my idea is to just try to stay in the right sectors, and that's always sort of my plan of attack, is to say, where do I need to be with my money that's going to perform this year? Mm-hmm. So, I started off thinking that over the turn of the year that not much was going to be different in the new year, and that energy should perform, natural resources should perform. And with rates probably going higher, tech might remain under pressure and continue to have a couple of lousy years. And what happened was we got the short covering in tech right out of the gate this year. And because a lot of those names and sectors had fallen so far, they have so much to retrace on the upside. And, that changed the complexion of a lot of sectors. So the sectors that were, like social media, that was just on its way down for a whole year last year, finally found a bottom and rallied. And now you've got Netflix and Nvidia, leading tech back out of this hole. So it's an interesting dynamic. So what you've got to do then is pivot your book and say, okay, well then let me grab a hold of semiconductors. Let me try to get a hold of the sectors that, while I may not be bearish, the charts leave a lot of room for upside retracement, and those are the kind of trades that I can buy into. So really the whole year so far, Tom, has been sort of, staying quick on your feet, continuing to let the market tell you what's going on rather than, form an opinion and, God forbid, think that the world is going to conform to that. Mm-hmm. Because in this tape, with the headlines that we've been seeing, attacks on infrastructure all over the world and things like that are, inherently bullish commodities to me. It's hard to have a blanket idea, but that's the plan that I'm sort of navigating. I hope that made sense. And I'm happy to sort of, drill down into any areas that you want to talk about. I don't want to just keep talking here.
Yeah, absolutely. Well, I like to try to let my guests explain where they're going, and there's a million jumping off points, but why don't we start with that yield curve inversion? It seems like such an important, or in the past, it has seemed like such an important indicator. Do you think that is kind of broken, and how do you think about that?
I don't know if it's broken or if I'm not good enough at reading it or what it means, but what it has generally meant is that you've got to expect sort of economic data uncertainty, waterfalls in the bond market, waterfalls in the equity market, and expect the uncertain, a little bit more volatility than usual, right? We're not in like the 2014 to 2018 time period where, the market was just grinding higher on, better economy, low interest rates, and, literally low volatility. So now we're seeing that all change across most asset classes. And like I said, you've got to adjust. So the yield curve for me just means, and like I said, Tom, I'm not a bond trading expert. What the inversion means to me is that, the market is perceiving the economy as being, sort of on the move somewhere, right? There's definitely, the market is picking up signs of inflation. The bond market did, did not just go and fly to a new high on relatively benign headline inflation data because they don't sense more inflation coming. You know what I mean? That's kind of how I looked at last week and how the market reacted in that next week after we got CPI and PPI. And to me, when I read the data, the data wasn't terrible, but it was, sort of signs that inflation is going to be with us for longer. And I feel like that's what the bond market is reflecting. Mm-hmm. So there's that side of the market that kind of is really super sensitive to these inflation triggers, and treasuries sell off. And of course, there's going to be parts of the bond market that are sensitive to other weak signs of economic data, like weak housing and things like that. And, you'll see the treasury market rally and rates back off. But with the inversion, it kind of just keeps me on my toes and to sort of not expect the data to all be one way or the market to all be one way. And sort of, as a trader, what you build into your plan is you trade a little bit more often, right? When things are going your way, you unfortunately part with it faster because, the last time this happened, it went the other way the next day. So it's kind of like, you have to feel that give and take and be a little bit less headstrong with your positions. But the beauty is that I feel like positioning is pretty tame in this market. We've seen open interest in crude oil, really come off hard in the last several years. I think it has a lot to do with lower US production, but I think it also has a lot to do with less speculation in the markets because we haven't seen, for example, a gigantic long or short position that the market tends to draw a bullseye on and start, pinning for the stop loss in the other direction of, right? So with positioning kind of tame, it's been a market that you can just put your positions on and trade your view and not have to worry too much about getting buried in sentiment unless you get too bearish stocks at the lows. That's one thing that I think is kind of a pervasive theme to the markets right now. Is that, the inverted yield curve definitely does, conjure the idea that a recession is coming. To me, the majority of the trade world population is looking for a recession and also necessarily thinking that means that valuations and stocks have to go lower. And I don't necessarily think that that's the case. I don't think that that's the right way of thinking about the stock market, but we'll see what happens.
On the idea of inflation, is it kind of a chicken or the egg problem here of inflation causing rising commodity prices or rising commodity prices causing more inflation? How do you think about that dynamic?
Yeah, it was commodity prices got out and got on their horse, and gasoline went from basically $2 to $5 when the Biden administration took office. After the several executive orders. So that was a kind of straight line commodity move that didn't show up in headline inflation until a little bit later, right? And then by then they were unloading the SPR. Natural gas was having an episode on the downside because there was warmer weather than usual, basically around the world. And we had that slide, and then the sort of pullback in headline inflation finally showed up. So the dog wags both ways, in my opinion, Tom. I think if that's fair to say, I feel like I've seen a little bit of both. But what I am counting on is that, the commodity markets are still, even though they've backed off quite a bit, they're still undersupplied. The demand is still relatively strong. I'm talking about the energy markets where, global gasoline demand is still growing. And that's why the crack spreads are all very well bid and the calendar's still pretty tight. And I feel like those are the dynamics that are going to take over on the commodity side and keep that rally going. That will sort of keep headline inflation in the works for some time to come, if that's a fair answer to that question.
So, Tony, how do you stay up to date on any of these dynamics changing? And when do you make the decision to back off of one of these theses if there is a change in that? Like, is there a certain point where you see maybe natural gas is a good example, because I know you had a certain target at the beginning of the year on that, and I think it went lower, quite a bit lower than that, right?
Yeah. I didn't have as much of a target in natural gas last year. I'm just recently getting bullish now is quite honestly the only view that I've had other than it's likely to go up. Like I haven't traded or been as bullish natural as I have been WTI crude oil and diesel fuel. So if I can I'll give you an example within that context that comes to mind is, I've been long, for example, Marathon Petroleum for quite a while, since last year on my pad. With the biggest US refiner, right? That stock rallied really, really sharply while let's call it the 3-2-1 crack spread on Bloomberg rallied from, say, $20 to $60, right? That's Marathon Petroleum's margin right there, right? So if you're a refinery, you just went from making $20 a barrel to $60 a barrel. Obviously, your earnings are going to reflect that. Excuse me. And that's why all those stocks rallied all year last year and were some of the best performers. But the crack spread peaked in June at $60 around the Russia-Ukraine invasion and backed off back to $30 after that. So the whole time I'm watching this pullback in the crack spread, I've got my finger on the sell trigger in Marathon Petroleum because I'm waiting for it to, break its uptrend or do something like that and maybe collapse. So I'm ready to make a sale and take profits. And the market in Marathon never got to my trailing stop, so the trend remained, in positive territory because broadly speaking, E&P stocks were trending higher and that sector was trending higher. And while I was ready for one of the driving dynamics to take me out of the trade, it definitely pulled Marathon back off the highs a couple of times, but Marathon Petroleum stayed on its own within its own uptrend. So that was just an interesting dynamic that sort of brought me out of last year even more bullish of refineries, right? Watching that behavior in 2022, where the crack spread went from 30 to 60 and they rallied, and then it went from 60 to 30 and they kept rallying. That sends a signal, right? That sends a signal that refineries are wanted, in the within the equity complex. And I don't even think that all we've seen really is tremendous outflows from a lot of the energy ETFs. Right. And I think that's sort of testament to the size of the trade that the size of the people that think we are heading for a recession and are probably betting on a lot of demand destruction.
Okay. So yeah, that's an interesting point there about the idea that recession brings a good amount of demand destruction within the oil complex. How does, let's say, balancing that on the other side with this long war we're almost, or I think we're a year in now, and also maybe China's reopening, how does that play into that thesis or your thinking around that as well?
Well, I just wrote a note the other day that was very much, I added oil to my view matrix because I wanted to be battle ready. That was, that was the name of the article, the name of the note that I wrote. And it was really just about the fact that, we just escalated, it's been a year, obviously, since the Russia-Ukraine invasion. Then you see Joe Biden head over to Ukraine. You see Vice President Kamala Harris call President Putin, accuse him of crimes against humanity. Then you see Anthony Blinken potentially accuse China of helping Russia with arms in, the conflict against the U.S. and Ukraine. And you see public support starting to fade for the Ukraine effort here. And because it has this big, huge propaganda machine attached to it, I get the feeling that, I get a little bit worried that I'm going to wake up one morning and crude oil is going to be $20 higher. And I'm going to have to go figure out why that just happened. And it seems like, it's not something that I want to bet on, but as a risk manager, I look at the way energy is trading and I see that the downside feels limited. And I look around the world at what's going on. And, then Putin immediately, while Biden was in Ukraine, did some ballistic nuclear missile tests. And so that just makes me a little bit nervous. I'm shocked that it doesn't make the market nervous, but it's also not making the market curl over and sell. So I feel pretty comfortable, long oil and oil products and oil stocks at these levels, just because I feel like the upside is super, super vulnerable to a headline. Now, the market isn't really pricing in that risk, as you can see. I mean, oil is $75 a barrel, the price that I've been saying that it likes for weeks now. And, there's no upside shocker to any of this saber rattling going on over the last week. So maybe I'm overreacting to that, which is possible. Or maybe I'm early and maybe I'm just dead wrong. You know what I mean? And oil is going to continue lower, but that's not the way that I'm looking at it with the world shaping up the way it is. So yeah, I'm trying to factor in everything that I see going on and have risk on where I don't think that agrees in price, or at least where the risk reward lines up and things like that. Those are the trades that I've been hunting all year, Tom. And they're hard to find. Like we said, it's been one of the toughest years to figure out in a long time.
Tony, as we're talking about the crude price, what's the significance of the break-even 5-year versus West Texas Intermediate crude price? I know you kind of look at that. So why is that an important indicator for you?
Well, they're not. I'm not going to call them like a 1-to-1 correlation or anything like that. But the break-even 5-year has been a really great beacon for what the market is expecting on the inflation front. rallied the whole year through 21 and 20, and then finally found a high and, sold off when the Fed started fighting inflation in 22. And then we backed off to the previous year's high and we're bouncing again. So to me, the break-even 5-year really fits, really gives you an accurate depiction of market-based inflation expectations. And, a lot of the time, the break-even 5-year is looking over at energy prices without a doubt, right? And so, it finally, broke the uptrend in the break-even 5-year when, oil spiked and peaked into the Russia-Ukraine invasion, and then finally started slowing as we had sort of a deceleration in headlines, right? As the sort of, the known knowns became quantifiable, and it was like, okay, this is what this risk is all about, and the price finally backs off. And then it backed off right into the summer of last year, where heading into the election, the administration decided to spill the SPR to sort of help it a lot lower. And I think that's what probably kept oil from trading up through $100 last year. But I don't want to get too far off topic. Mm-hmm. Those things, if you look at them on the charts together, they sort of have been tending to trend in the same direction and have similar pivot points. So that's why I think it's relevant to follow those two together as an oil trader, kind of keeping a close eye on market-based inflation expectations everywhere I can get them. Mm-hmm. So that's that correlation.
So how does the dollar play into all of these theses as well, Tony? The dollar has had a pretty dramatic uptrend for the last 2 years. Is that now broken? And that in a lot of ways helps a lot of these other trades as well, because all of these commodities are priced in dollars.
Great point, Tom. The dollar is super central to a commodity trader's radar screen, obviously. So I do think you touched on one point that has that dollar trend higher peaked and turned, and I can make a good case that it has. Mm-hmm. You got to, first of all, you have to look at what stopped it from going up, because if you remember last year, it wasn't a question of if the dollar was going up that day. It was just a question of how much, mm-hmm. And it was a question not of, whether the dollar index was going to be up 1% that week or 3% that week. And all of a sudden that dynamic changed, and it changed because in the UK, they had to intervene when Liz Truss took office and everybody lost confidence in the gilt market and it started collapsing. So they decided they had to defend the gilt market by buying gilts and by buying cable against the rest of the world. So that was the first central bank shot across the currency market bow. That turned the dollar quite a bit. And then the dollar bulls came roaring back. They ran dollar yen up to 150. And the Bank of Japan said, whoa, hold on a second. You're starting to break shit over here now, right? So they start defending the yen. If you look at the chart, those two central banks mark the top of the dollar move and then the collapse down through there. Mm-hmm. Now, to me, Tom, technically speaking, the writing is on the wall so far where the dollar should fade, dollar index I'm talking about, just to keep it simple, should fade resistance now and potentially head back lower. Now, the reason I think that is because the narrative has picked up a lot of the central bank digital currency narrative has picked up a lot of momentum, I feel, in the last 3 to 6 months, where, whether maybe it's being discussed over here, but closer to being implemented in other countries. So I think that could potentially take purchasing power away from the classic greenback. And then, you have to have your eyes open to see what Putin and Xi Jinping and Mohammed bin Salman are trying to put together, and Modi behind the scenes, where they're pretty much setting up their own commodity markets to be traded in their own currencies so that they can go around the petrodollar. Mm-hmm. And if you ask me, that's a big part of the reason why we're talking about going to war and escalating things right now against China and Russia together. So, this picture gets a lot murkier if you try to figure out the political implications, because that's something that I'm just not good at, Tom. I just kind of look at the screens and let them tell me what the hell's going on. And, we are in a period of bearish dollar move retracement right now. And that just seems logical with the move in yields, right? So dollar yields took off and made a new high, and call it the 2-year yield. Not shocking that the dollar is going to pick up a bid and call it short covering on something like that. But if the narratives that I just described are still, those currents are still as powerful as I feel like they are, then I think the dollar can trade a lot lower this year still.
Mm-hmm. So does a gold trade coming into this year depend mostly on the dollar as well? Or are there other reasons for you to look at and be long gold, Tony?
I think there are other reasons to be long gold. But I do think that, as we've just witnessed, if you've got the dollar going against you, if the dollar's rallying, that's obviously going to be a heavy headwind for gold. So, that's what we just saw, was that period where yields had found a high, gold finally bottomed, right? And yields backed off and consolidated, and gold went on a great run. Then all of a sudden yields popped again, and all the money came out of precious metals, and everybody said, oh, let's stuff our money in the treasury market at 4%. So I think that that's a big dynamic of what's driving the gold market. But I think on the other side of that, if it's true that central banks are really buying gold at the pace that they're buying it, and sort of diversifying dollar reserves by buying gold, which is the story that you read, that's a really compelling story for gold, considering we're in a pretty inflationary environment. So I guess the head scratcher was really, why was gold not rallying while headline inflation went from 2 to 7%? Mm-hmm. Right. And I think the beginning of that answer is, number one, I think Bitcoin was soaking up a lot of the liquidity in the room at the time. Mm-hmm. And I'm not necessarily saying that's 100% why, but it was clear to me that in 2021, Bitcoin was the best inflation hedge and gold was not. And then you got to 2022 last year, where gold didn't do anything on the upside either, and we saw higher prints and headline inflation. So right now, gold is doing a crappy job at being an inflation hedge, but I still think it's doing a pretty good job as being a monetary hedge, mm-hmm. Which is kind of the reason that I prefer to stay long physical and not worry as much about that gold trade that seems to be crowded and obvious and that kind of thing. So as long as I've got coins under my pillow, just in case the dollar really, really devalues in a terrible way, then that's the way that I want to approach the gold market, as sort of a long physical always type of thing. If that's fair to say, Tom.
Yeah. And I think obviously a lot of the geopolitical risks that we went over earlier here play into that thinking as well, right?
Yeah, totally. It's if we're going into a period of resource nationalism and I was in charge, I know that I would be hoarding quite a bit of fucking gold. Excuse my French, quite a bit of gold, and that seems to be what China is doing. And so you want to keep an eye on what they're doing, and especially if they're trying to have a major effect on the currency market, like the way they are. So, if you look at the fact that, Russia diversified, from US treasuries, and apparently they don't hold anymore, and they've significantly increased their holdings of gold. China is another one of the big central banks with a huge physical gold position. So you have to respect that. These are the countries that are getting nationalistic about commodities, and that's something that you have to really sort of raise an eyebrow when you see the U.S. spilling out the SPR at the same time. Mm-hmm. It's saying, "Oh, we're going to take the exact opposite approach of that." Then, okay. Let's see how that works out, and I don't know the answer yet, but like I said, if I was playing a game of global stratego right now, I would be socking the vaults full of physical gold for sure.
Mm-hmm. Yeah, sometimes that political expediency doesn't necessarily make sense in that broader, the broader way of thinking about, as you say, having reserves going into this geopolitical climate.
Yeah, it's a little bit tricky right now, isn't it?
Yeah. So one of the other things that I'd like to go over, Tony, is kind of the behavior of natural gas and any of your thinking around that. We did kind of mention it earlier. How do you explain the behavior of this market this year and getting to such lows in the middle of the winter here? Was that a lot of buying ahead of the expected cold winter and, the volatility in Europe that didn't end up happening? How do you look at that? And then also going ahead or looking ahead, at even next year?
Yeah. So I think, Tom, that the reason that we had such an overshot and such an exaggerated downside is because the way that Europe's winter played out left us with a pretty big, well, I wouldn't say big, left us with a mini bubble on the upside. The world was quite bullish natural gas, for that run, and natural gas, stayed up at the highs at around $8-9 or $7-8 for quite a while Europe was going through its crisis of seeing electricity prices spike to €300 per megawatt hour. So that's when it got hairy over there. That's when Dutch TTF natural gas prices were flying off the screen. And, like anything else, the cure for high prices winds up being high prices. And I don't know if that was actually the reason for natural gas backing off, but Europe was really, I mean, they had to spend $500 billion and got Mother Nature on their side with warmer weather to fight their way through the winter. Let's not forget that they're the ones that bought natural gas like a drunken sailor up to $10 to fill up their storage tanks for the winter. Right. So, if you saw that pan out, it was hard to think that the price was going anywhere but higher. And the next thing you get 6 to 8 weeks in a row of warmer than expected forecasts. I mean, we essentially had no winter, I would say is fair, in the Northeast in the US, and also a very, tame situation in Europe. So there was not massive need for, all the heat capacity that it would have normally been burning. And they got let out of a bad trade. The game there is, it's obviously not over. Obviously, with somebody blowing up the Nord Stream pipeline, the European gas situation is not over, right? So whether it's directly related to the Nord Stream or Russia decides to close the taps in retaliation or something like that, my guess is that natural gas is going to go into play again before next winter, right? But what happened was, on that, and that crashed down, we had the same, set of hotter than expected prices here, temperatures here in the US. We probably had a market that was a little bit long, if anything, and we saw natural gas crash to $2, right? So what I just have been writing about and keeping a close eye on is that, we've definitely seen everybody throw natural gas out like the baby with the bathwater in terms of commodities. Like nobody can stay long something from 8 to 2. Right. So that is officially gone from everybody's position sheet, and everybody's kind of just watching now to see what happens. And when you see the price action like we saw last week, and this may sound like a little bit of tea leaves, but a lot of times it winds up coming to fruition. Natural gas has been in a low range of like $2.25 to $2.75 at the bottom. Last week, it took a nosedive through the bottom of the range, tested the dollar handle, right? We're traded $1.95 and then back above $2 and $1.95 again. And then it traded straight to $2.70 last, right? Like this move off of that $1 handle, one touch has been a straight line, right? So in my opinion, now, if we go through the top side of that old $2.25, $2.75 range, after having that spill at the bottom and recovery, man, then that's to me, that's when the upside is vulnerable. And if you want to just look at if you want to see another example of that pattern, look at the S&P when it was at the lows. It was in a range of like 3,600, 3,900. And all of a sudden on a Thursday, I think it was October 16th, if my memory serves me correctly, it took that 100 handle spill to 3,500 and 100 handles back to 3,600 in the same breath, right? So that's when a trader is like, oh my God, here comes a big spill. We just broke the bottom of the range, and the security comes flying back up into the range and keeps going. That is as bullish price action as it gets, and we just saw natural gas do that. And so far it's panning out. And with, there's like, the thing could double and not even reach resistance on the upside, so it's a really, really tempting trade to get into down here. We'll see if the physical side and if the narrative holds up. But that's low hanging fruit to me that I'm probably going to be trying to trade one way or the other if it happens. And we're kind of right on the doorstep with natural at 275 265 right now.
One of the other themes that you laid out kind of looking ahead to this year and this quarter was the aggressive stance of the administration that they were maintaining towards their carbon neutral targets. So what materials do you think continue to benefit from this trend? Is it aluminum, copper, the electric or energy metals? How do you look at that play from your perspective, Tony?
It's really broken right now, Tom. It's really hard, right? Because we know that we've still got the pedal to the metal in terms of our transition to electric battery power, right? That the administration and the powers that be are not letting up on that, right? We still see John Kerry just weeks ago, claiming that it's unbelievable that, people like him are actually trying to save the planet and are going around the world, and we're figuring out how to lower the carbon, right? That they've got their pedal to the metal, right? So there's no let up. Knowing that there's no let up, you look over the commodity world, which is pretty low inventoried at the moment, and say, man, they must be soaring. Guess what? They are not, right? Aluminum is bottom feeding, and aluminum, nickel, zinc are all below all of their moving averages right now. So all three commodities have disappointed the trading public and are still pretty much somehow, not rallying sharply, right? Now, cobalt is another story, lithium is another story. There's probably some shortages of those. There's some shortage stories of those on the tape. To me, they aren't as tradable. They're just part of the sort of rare earth complex that goes alongside the electronic vehicle story. So it's been a kind of disappointing trade for a while to be in the metals because of that transition, because we just ran into this whole idea that the economy is going to be slowing down so aggressively, right? So that took the piss out of the whole metals rally. And now we're kind of back to where we started, with copper trying to break out, but not doing a great job, and the rest of them just not going anywhere. So that's one of the reasons that it's been a really tricky dynamic, because it's an appealing trade that's not really working great. And I'm trying to think of how else I can sort of square up that idea. Yeah, here's another thing. Iron ore, since the whisper of China reopening, iron ore has gone from the bottom left to the top right of your screen. It's probably rallied 40% in the last 6 weeks. Base metals, nothing. Energy, nothing. Right. So it's really difficult to sort of connect those dots all the time. And I'm kind of attributing it to this, this sort of chaotic state of the markets that we're in right now.
Right. On the energy side of that kind of carbon neutral target that they have, do you think that we're seeing a broader turn by the public of being more accepting of nuclear energy and by extension uranium as well?
I can't get a read on it. It feels like at least the right people are circulating the right information. Like, it's important to me that people like Doomberg and Grant Williams and, other major voices in the market are talking about that uranium is a natural transition, and like Doomberg says, if we were all standing around and uranium and the nuclear power was discovered today, we would probably go ahead and use it as the, be all and end all and salvation for everything, right? It just makes all the sense in the world. But we've been conditioned with, a couple of nuclear accidents on the course of history, et cetera, et cetera. And I feel like the environmental agencies have done a great job making everybody still be fearful of nuclear spills and things like that. And we've learned from Bloomberg and several other sources that in this day and age, they're pretty much totally containable. And everything becomes a game of dilution. And I think that they've sort of figured out how to tame the sting of a nuclear accident. So with that being the case, I do think that at least it's permeating the psyche of the market. I'm a last sale rules guy, right? And if the uranium sector isn't going anywhere, then it's hard for me to say, oh yeah, this is happening, we're going right to nuclear. It's like, and then there's the theory that once we know there's more uranium definitely being brought onto the markets. So the sort of bear case in uranium is that, with more production coming on to service any sort of nuclear operations that are going to pop up, there doesn't need to be an incremental move in the uranium price. So while that may mean that the mines can do a lot better, doing a lot more business, processing a lot more uranium, it doesn't necessarily mean that the price has to go higher, which is something to consider. So, I think it's relevant. I try to keep my ear to that pulse. and sort of not get caught up in the fact that if price action isn't going along with it, then the market's just not excited about it.
Mhm. Yeah, it's such a, like you say, I think chaotic markets is the best way to describe all of these things that we've talked about. But when we think about these broader themes that we've discussed here, do you look at the picks and shovels or drills and service rigs of these respective industries as strong ways to play these themes? And what kind of fundamentals must be in place for you to find these particular companies attractive?
I'm not a fundamental guy. I'm a price action guy. So they land on my screen when they take off and move.
Mhm.
And that's quite literally how, I that's the mode that I use to navigate my way into trades. I'm usually looking for this. I'm usually hunting the same pattern, but let's stick to the sort of energy investments where, the picks and shovels and the drills, et cetera, et cetera. Yeah, I think I'm sticking to my guns this year, that even though technology got off to a banging start with kind of social media and semiconductors, really leading the pack on the year, that by the time the year is over, that it's still going to be energy and natural resources that wind up performing, because I still think that we're going to be in a higher rate environment where, broadly speaking, the S&P goes nowhere. Mm-hmm. So I think the S&P goes nowhere because the big tech is probably going to be challenged in a rising rate environment. Mm-hmm. So I think big tech goes sideways to nowhere, maybe a little bit lower, and that really weighs on the broader indices. But like we saw last year with the S&P off 16%, you still had oil services up 48% and energy up 40-something% and 30, up 30 to 40%, which are pullbacks from the highs. Right. So at least, the market has given you an example that those energy sectors and natural resources sectors can rally in the face of an S&P slide. And so I think that that's important. And I think that that's what's going to, I think we're kind of living through a short covering rally in technology that's probably going to find a level and fail while natural resources stocks continue to perform. We gave that one example in refiners. We can start there and work backwards, right? The crack spread goes from their margin being $10 historically to being 30 bid at $60. Mm-hmm. That's why the stocks are up 65% last year. Yeah. Because that is likely to continue as long as gasoline demand remains steady to constant. Mm-hmm. Right? We can go into recession and global gasoline demand can remain absolutely flat. Mm-hmm. Right. And those companies are just going to be churning out money, and then you try to get into the XME trade, which has a lot of, coal stocks and steel stocks and base metal miners and, names like Freeport and Alcoa mining copper and aluminum. And, that trade is working because those stocks have been putting up great earnings and they do have a great fundamental story. Mm-hmm. The oil services sector, God, if you heard the Schlumberger earnings report a couple of weeks ago, I think it was their last earnings report. I mean, it was bullish. The CEO sounded bullish. The stock reaction was bullish. It's like that things are going well in that part of the world, even though the oil price is, $50 off the highs. Right. So to me, those are the sectors that I'm still, attracted to, that I feel like I have at least a little bit of an edge in, and I can hunt. And I can still, trade the other ones technically and trade the breakout in semiconductors and try to make some money there while that party is going on. Mm-hmm. But that's just the way that I'm thinking as a trader all the time.
Mm-hmm. We've kind of touched on the idea of how you're looking at tech right now. Does this rising rate environment and debt refinancing play the biggest role there in why you're kind of bearish on that sector?
Yeah, I do. And it also goes back to the fact that, they had technology just had such an unbelievable setup for so long, and then they got a cherry on top of the cake in the lockdowns. Mm-hmm. And so we've had rates pinned. We've had low interest rates essentially and ample liquidity for the growth companies to finance their growth really, really cheaply for a long time without any kind of inflationary threat at all. If you remember, we went through years where the Federal Reserve was desperately trying to get headline CPI north of 2, mm-hmm. And now it's kind of like, the worm has turned and you got to be careful what you wish for. But let me get back to my original idea. So the reason I'm bearish tech is because, they flourished for so long on low interest rates. And then we had the lockdown low. right? Where we had the stocks crash, but then we had the bubble in big tech certainly coming out of the lockdown when everybody was home shopping on Amazon, being social on Facebook, and that was basically it. So all those stocks had, their moment to shine, and where the world just was not going to look any better for them. And then obviously with the pivot much higher in rates, that party is over. And in my opinion, the danger about it is that everybody that I know that was long all of those names in their portfolio and just took the hit last year, they're still long them. Everybody's still long Facebook, Google, Apple, Microsoft. Nobody sells that stuff because they're still legacy ideas.
Right.
And I think that once we see, the majority of retail finally say, yeah, you know what, I'm done with these. There's been 2 or 3 years, and I'm talking about at the end of this year and maybe next year. Yeah, it's been 2-3 years of, no performance out of these things. I'm finally getting rid of them. Then I can say maybe there's a bottom in tech somewhere, but that's kind of how I'm looking for this to pan out. And on the other side of the coin, energy is, 3% of the S&P.
Right.
So it's still got so much upside to go versus the S&P itself that it's really easy for me to stay bullish in sectors like that.
One of the, I guess, stories that has kind of made news within the commodity circles is that the CFTC hasn't been able to produce a commitment of traders report for several reporting periods now. So they cited hacks as being part of the reason behind that. So how do you see that situation developing, and is it suspect to you, and why are they releasing data in the way that they are?
Man, it's easy to get conspiratorial here, and knowing that isn't necessarily a bad way to go in the last several years, it's probably worth kind of just, kicking around some ideas. There are people, and I'm going to kind of just frame this from the third person because I don't know what I think about it. Right. So what I'll tell you what's out there is there are people that are saying, like, how is it possible that, we've got the energy department gushing the strategic petroleum reserve out, trying to get the price of oil lower and gasoline lower. And all of a sudden we can't get a read on futures positions for a really long time, right? That leads the nervous, anxious futures trader to think that maybe there's some chicanery going on in the futures markets. Now, I don't necessarily believe that that's the case. I don't know if that's has anything to do with it. It's a little bit strange. Like the commitment of traders reports are important, but they're certainly not the be all and end all to trading. And as you can see, for the last several weeks, the sun keeps rising without them. So it's not like they are, they're not critical to the plumbing of the financial structure. You just put it this way. I just have to lump the ion hack into the other set of attacks that we've seen on American soil that I don't really know how to process. You know what I mean? I kind of put them in the same pile, right? For a string there, we saw all those attacks on the food processing plants. And then we saw the gunfire attacks at the baseload power stations. And then we saw all the train derailments. And then and then we've got hacks galore going on. And I don't know, maybe somebody's upset that they got their pipeline blown up. Maybe it's somebody else entirely. I have no freaking clue. But as a tape reader, it's all observable. It's observable, isn't it, Tom? Right? I mean, I'm not making any of this up. Just because I don't know what's causing it doesn't mean it's not happening, because we can point to it. So I kind of throw the ion hack into that pile with, man, I got a feeling that somebody that's trying to wreak havoc here has just found some vulnerable buttons. And whether it's on the train track in Ohio or on this server where the ion system is, they just decided to throw a couple of butter knives in and see what they can do. And apparently it's working. So that's my only read on that, is that I don't know, but I kind of throw it into a little bit of a conspiratorial pile and say that somebody is doing this to us on purpose.
Right. Yeah. It's hard to kind of take a step back and look at all of these situations, all of these particular events, and think that there's not maybe a bigger theme there, right? You say it as attacks, they're not necessarily always framed like that. Right. But again, taking a bigger step back and viewing it from a more, as you say, maybe a macro lens, it's hard to not see a theme there.
Yeah, well, we just had, one of the last of the Mohican accredited journalists write a piece about the Nord Stream pipeline being blown up by the Biden administration. right? Now, I mean, if you're on the other side of that coin and you have sort of proof to that, or you have that's your idea, and then you see the approach by the administration after that, right, saying that it is completely, I think the term that they used was malarkey, was the guy's term from the Pentagon, the spokesperson. Now, they don't see the media getting Jake Sullivan or Victoria Nuland on 60 Minutes and saying, hey, what's the story here? The whole world thinks, and the whole world is guessing, and one journalist has got one really good source that says that you guys did it. You want to defend, there's no coming to a moment of clarity there. There is just an outright denial. Mm-hmm. So if that's going on and you're unhappy with that process and you feel that you were the one that was wronged, then, I understand that none of these, all of these things that happened on U.S. soil could be framed as accidents that I just say attacks, because it seems like the pace and the regularity of them has certainly picked up, and
especially in particular sectors.
Yeah, exactly. Very right. Exactly. Very directly related to the natural resources sectors, kind of like you take our pipeline, we take your, chemical train. And I know the East Palestine, Ohio train is it's a little bit of a unicorn of its own in terms of how toxic it is and whether it's really not that dangerous and whether the EPA's response was good or whatever it is. That seemed extremely unnatural, and there's a mushroom cloud in the sky. Mm-hmm. So it's something that I think should probably be addressed at some level. That's all. Mm-hmm. And that's where we are, man. Tom, that's the whole chaotic thing is fielding all these headlines and getting really concerned, and then looking over at the VIX, and the VIX is 20 bid at 21 and doesn't really care, and the equity market's trading like May wheat and everybody's fine with it. Oil's trading sideways right at this price, likes these prices, doesn't dip much, doesn't rally much. The spreads are where they've been for a month now almost, and it's business as usual in the commodity markets, which at the moment is kind of leading them down. Mm-hmm. But to me, they're trading down like a beach ball underwater, just waiting for like one bigger headline, one more important headline, one headline more related to, U.S. in support of Taiwan or something like that I feel like we're being set up for. And next thing you know, like you can't buy oil once that headline comes out. So I'm happy to sit here and babysit the position for a little while until we get it or until the market takes me out. I have no problem leaving that bet up on the table.
Mm-hmm. Yeah, it makes sense. And as you say, being nimble and understanding why you're positioned the way you are is most important here, I think. Tony, I want to thank you for your, go ahead.
No. I was just saying, and then when you at least see oil and gasoline pound the downside a bunch of times and not curl over, at least that's where your risk is, right? And that's really all it is. I'm not even claiming as much that I'm going to be right in as much as I like the fact that I can probably risk 3 and make, 10, 15, who knows on the upside in a headline like that. So I just feel like that's what the sentiment is ripe for. So we'll see what happens.
Mm-hmm. Excellent, Tony. I want to thank you for your time today. Is there anything else that maybe we didn't touch on that is on your mind, or that maybe you're looking forward to for this next quarter that's maybe top of your mind to include in your list for quarter 2 here?
Yeah, I came into the year, Tom, hunting the upside oil trade. And I don't want to sound like a broken record, but I do want to sound like a really capable trader, right? And a really capable trader might be hunting this move where oil goes through the 50-day, the 100-day, the 200-day and keeps going. Mm-hmm. And we may hunt that move and take 5 or 10 shots at it and miss and be perfectly okay to continue to shoot at that target. Because to me, that's still the sort of low-hanging fruit where we get into some kind of a political resource nationalistic disruption, and all of a sudden crude starts tripping up through those moving averages and doesn't come back for a while. Mm-hmm. So I just want to say that, I don't mind sounding like a broken record, because I still think that the chances of that trade happening in 2023 are so high mm-hmm. that I'm willing to sort of, like I said, waste many bullets shooting at it before I get it right. Right. So that's one thing that as a trader, you can't get it off your brain until the market proves that it's something that's not going to happen. So I'm going to keep hunting that until I see it transform right before my eyes. And then the one other thing that I would just love if you could give me a chance for a shameless plug, go to TG Macro at substack.com, which is Navigator TV. So that's my new free offering where I've been putting out videos about the markets between 2 and 5 minutes that are on, either specific topics or just recaps of the week. And they have some of my views included. So that list has been growing really nicely. So I just wanted to mention it here on your show if I could.
Yeah, absolutely. I was going to say you started a new Substack since the last time we spoke. And yeah, very concise, short videos to let people know what you're thinking. Of course, you're available on Twitter as well at TG Macro and tgmacro.com, right?
That's the one, man. Thanks so much, Tom.
And wonderful. Thanks for your time today, Tony. I really appreciate it.
Anytime. I'll be back anytime you need me, Tom. That was awesome.
Excellent. Take care.
See you, pal.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.